Derivatives are financial contracts that derive their value from an underlying asset, such as a stock, commodity, currency, or index. These contracts can be used for various purposes, including hedging risk, speculating on price movements, and generating income. The derivatives market can be traced back to ancient civilizations, where individuals and merchants would use forward contracts to hedge against the risk of crop failures or price fluctuations. However, the modern derivatives market as we know it today has its roots in the 19th century, specifically in the agricultural market. Farmers would use forward contracts to sell their crops at a fixed price in the future to protect themselves against the risk of price fluctuations. In the 20th century, the derivatives market expanded into other areas, such as the commodity and foreign exchange markets. The Chicago Board of Trade, established in 1848, began trading futures contracts for agricultural commodities, and later expanded to include financial instruments, such as treasury bonds and currencies. In the 1970s, the development of financial engineering and the widespread use of computers led to the creation of new derivatives, such as options and swaps. These financial instruments provided investors with new ways to manage risk and speculate on price movements. During the late 20th century and early 21st century, the derivatives market continued to grow and evolve, with the introduction of new financial instruments such as credit derivatives and weather derivatives. However, the market also faced several crises, such as the collapse of the hedge fund long-term capital management in 1998 and the subprime mortgage crisis of 2008, which brought attention to the potential risks of the derivatives market. Despite the crises and criticism, derivatives continue to play an essential role in managing risk and providing liquidity in the financial markets. The use of derivatives has diversified and spread globally, and it is a vital part of the global financial system. There are several types of derivatives, including futures, options, swaps, and forwards. Futures markets are contracts that obligate the buyer to purchase an underlying asset at a predetermined price and date in the future. Options markets are contracts that give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and date in the future. Swaps markets are contracts in which two parties agree to exchange cash flows based on the performance of an underlying asset. While forwards markets are contracts in which two parties agree to buy or sell an underlying asset at a predetermined price and date in the future. Nevertheless, the derivatives market has several advantages, including the ability to hedge risk, speculate on price movements, and generate income. However, it also has several disadvantages, including complexity, leverage, opacity, and counterparty risk. It is essential for investors to fully understand the risks involved before entering into any derivatives contracts. In summary, derivatives are financial contracts that derive their value from an underlying asset. They can be used for hedging risk, speculating on price movements, and generating income. Although the derivatives market is complex and opaque and can amplify losses, it is very essential for investors to fully understand the risks involved before entering into any derivatives contracts. In addition to what has been discussed already, there are several other key aspects of the derivatives market that are worth noting. 1. The size of the derivatives market is enormous. According to the Bank for International Settlements, the notional amount of outstanding derivatives contracts was around $640 trillion at the end of 2020. However, it is important to note that the actual market value of these contracts is significantly lower. 2. Derivatives markets are often interconnected with other financial markets. For example, movements in interest rates or currency exchange rates can have significant impacts on the value of derivatives contracts. 3. The derivatives market is subject to regulation in most countries, though the specifics of this regulation can vary widely. For example, in the United States, derivatives markets are primarily regulated by the Commodity Futures Trading Commission, CFTC, and the Securities and Exchange Commission, SEC. While in the European Union, they are regulated by the European Securities and Markets Authority, ESMA. 4. There is a majority of people criticize the derivatives market. They said it is contributing to market volatility and instability. During the 2008 financial crisis, several large financial institutions' failure was partly due to their exposure to complex derivatives contracts. 5. Despite the risks, derivatives market remains an important tool for many investors and companies. Companies can use derivatives to manage risks related to fluctuations in commodity prices or exchange rates, while hedge funds and other investors may use derivatives to make speculative bets on the direction of financial markets. Overall, the derivatives market is a complex and dynamic aspect of the global financial system that can provide benefits to those who use it effectively, but also carries significant risks. As with any investment, it is important to fully understand the risks and benefits of derivatives before engaging in any trades.